They gave you a ruler. They pointed at a few old highs and lows on a chart and said, there, that is where price stops. That is where it bounces. Draw your line and trust it. And you did. And the market walked right through it. Again, and again, and again. I know that feeling. I lived it for years. Lost fortunes because of it. And I am going to tell you today what nobody in any trading course will ever tell you. Lines on a chart do not stop price. People do. Fear does. Greed does. Memory does. And until you understand that, you are not trading the market, you are trading a drawing. My name is Jesse Livermore, and this is the truth about support and resistance that took me a lifetime of wins and devastating losses to finally understand. Let me start with a question. When price rises to a certain level and turns back down, what actually happened? A textbook will say, supply entered the market. Fine. But why? Why at that exact price? Because the traders who bought lower saw their chance to get out with profit. Because the traders who shorted earlier finally got their vindication. Because the traders who missed the move decided, this is too high, too fast, and placed their bets against it. Price did not stop because of a line. Price stopped because of human beings, making decisions based on memory, pain, and expectation. That is the entire foundation. Support works the same way. Only in reverse. When price falls back to a level where it previously found buyers, it finds them again. Not because the chart said so, but because a crowd of traders remembers that level. Some bought there before and made money. Some missed the move and are waiting for their second chance. Some got shaken out at a loss and are waiting to break even. All of them are watching. All of them are ready. And when price returns, they act together and price bounces. That is not magic. That is not technical analysis. That is the collective memory of the market, expressing itself in real time. Now here is where most traders go completely wrong. They treat support and resistance as binary. Either it holds or it breaks. Either the level is valid or it isn't. But the market does not work in binaries. It works in pressure and time. A level is not a wall. It is a zone of accumulated emotion. And the question is never simply, will it hold? The question is, how much pressure is building against it? And how long can that memory sustain itself? I watched men of tremendous intelligence and capital draw their lines with surgical precision, only to be destroyed when the market moved in ways their charts never predicted. The market did not break their support because their analysis was wrong. It broke their support because the story had changed. New people had entered the market. New fears had taken hold. The old crowd was gone. And with them, the emotional anchor that gave that level its meaning. This is the first truth I need you to carry into everything else. A level is only as strong as the memory behind it. When that memory fades, when the original buyers have moved on, the level is a ghost. It looks real on your chart. It has a line through it, but it has no teeth. So how do you know the difference between a level with memory and a level that is already dead? 2 clues: volume and time. Volume first. When a level forms with enormous volume, when a huge number of trades happened at that price, the memory is deep. Many participants have an emotional stake in that level. When price returns, all of them wake up, their emotions activate, and the market responds. Contrast this with a level that formed on thin volume. Price touched it briefly, a small candle. Very few participants involved, very few people with any emotional connection to that price. When price returns, there is no crowd to respond. The level dissolves. Time second. The older a level gets, the more the original participants have rotated out. The crowd that created that level 3 years ago is largely gone. New participants have entered carrying their own emotional anchors at their own prices. This does not mean old levels are worthless. Some become legendary precisely because generation after generation of traders has learned to watch them. But you must always ask, is this level living on original memory? Or is it surviving only because traders who came later have collectively decided it matters? The answer changes your conviction, and it changes your position size. Now let me address something that causes enormous confusion: role reversal. Support becomes resistance. Resistance becomes support once broken. You have heard this. but the reason it is true is almost never explained. When price breaks below a support level, everyone who bought there is now underwater, in pain, waiting, consciously or not, for price to return to their entry so they can exit without a loss. When price does return to that level from below, those same people sell. Their desire to escape pain becomes supply. Former support becomes resistance, not because of some mysterious market law, but because human beings are wired to avoid loss, and that wiring turns buyers into sellers the moment their perspective shifts. Understanding this will save you from countless bad trades where you are trying to buy a level that is full of trapped sellers desperate to get out. Now let me tell you about something I called the springboard move. The big operators, the large funds, the institutional players know exactly where the retail crowd has placed their stops. They know exactly where the obvious support and resistance levels are because everyone has drawn the same lines, and sometimes, not always, but sometimes, they drive price into those levels deliberately to trigger stops, to shake out weak hands, to create the liquidity they need to build or exit their own positions. It looks like this. Price breaks below a well-known support level on heavy volume, appears to confirm a breakdown. Retail traders panic and sell. Weak hands get stopped out. And then, price reverses sharply and reclaims the level. The false break is not a failure of support and resistance theory. It is confirmation of it. Confirmation that the level was real enough to be worth targeting, and that once the stop running was complete, the original memory of value reasserted itself. Now, let me bring everything together, the real truth about support and resistance. The one that took me a lifetime to fully grasp is this. You are not reading a chart, you are reading a crowd. Every line you draw is a hypothesis about collective human emotion. Every trade you place at a level is a bet on how that crowd will behave when confronted with a price they remember. And like all bets involving human beings, it is never certain. The only certainty is that the crowd has patterns, that those patterns repeat, because human psychology does not change. And if you are disciplined enough to wait for the patterns to confirm before you act, the odds will work in your favor over time. I was not always disciplined. In my early years, I acted on impulse. I saw a level I liked. I placed the trade, and I paid for it over and over again. My greatest losses were not caused by bad analysis. They were caused by impatience. I saw the right level, but entered before the market confirmed it. I saw the right trade, but sized it too large because I was in a hurry to recover from a previous loss. I let my emotions, the very thing I was trying to read in others, corrupt my own decisions. The market does not owe you a trade. It does not owe you confirmation. It does not owe you a clean level or a perfect setup. It is indifferent to your needs, your schedule, your account balance, and your feelings. And the moment you accept that indifference, not intellectually, but in your bones, you become a different kind of trader. You stop demanding the market perform for you, and you start watching for the moments when it naturally aligns with your thesis. Those moments are worth waiting for, and when they come, you act with full conviction, because you earn that conviction through patience and observation, not through hope. To those of you who have been hurt by this market, those of you who bought a support level that broke, who shorted resistance only to watch it explode through, I want you to hear this clearly. The fact that it broke does not mean you were stupid. It means the market changed, and the old memory was no longer valid. Your job is not to be right every time. Your job is to manage the times you are wrong so they do not destroy you, and to press hard on the times you are right so those gains more than compensate for all your losses. That is the entire game. Lose small, win big. A level that breaks is not a failure. It is information. The market is telling you the story has changed. Listen to it. Do not argue with it. Take your small loss, reassess, and wait for the next opportunity. Support and resistance, understood properly, is one of the most powerful tools you will ever have. It tells you where the crowd has been, what they felt, what they fear, and what they want. It tells you where the battle lines are drawn. And if you are patient, if you are disciplined, if you wait for the market to confirm before you commit, it will tell you again and again exactly where the next great trade is waiting. That is the truth about support and resistance. Not a line, not a level. A living record of human hope and human fear. updating itself with every tick, every candle, every session. Learn to read it as such, and this market will never be the same to you again. My name is Jesse Livermore. The market is always right. Make sure you are ready for it.